Vikram Gupta, founder and managing partner, Ivy Cap Ventures. Kanika Agrawal, partner, India Quotient. Vishal Gandhi, founder, Gandhi and Associates. And Shashank Pandey, managing director, O3 Capital. To set the stage for the panel, we'll have a short presentation on what the data says on the state of venture capital. To present the data, I welcome to the podium Arun Natarajan, founder, Venture Intelligence.
Get the screen. Can we get the screen up? Yeah. वो screen कर दे. Yeah, thank you so much. This is quickly to set the stage for the venture panel to follow. So this is a quick word about venture intelligence. So one of the things that we do, tracking private equity, venture included, M&A, private equity in real estate, and company financials, which is a big part as well. So, you know, a deep dive, if you need a one-to-one demo, for example, on this, please let us know at the registration desk, and, you know, we'll be happy to do that post this panel. So moving on, venture capital, you know, the word funding winter, that's something that's, you know, we've been hearing for 2 years plus now. What the data quarter on quarter for the last 3 quarters indicates, the slide before you, there is finally light at the end of the tunnel, and it kind of is shining through. 3 quarters, at least volume, which makes sense from a venture segment perspective compared to the dollar numbers that we speak of when we take overall private equity, it's clearly ticking up, right? So, and as you can see, this was not the case ever since mid 2022, right? So, having said that, if you look at it from an annual perspective, clearly we are ways off from the 2021 peak. And even if we project this latest quarter numbers and what we are seeing currently in this quarter too, you know, optimistically, we are going to, at best, equal from a value perspective, the 23 numbers, forget about 22 or 21. So, while, you know, whether you call it the early signs of recovery, clearly this is nothing compared to what 2021 or 22 even was. 23 is likely to be kind of matched. Who knows how things, you know, kind of shape up, public markets, to what happened yesterday, to so on. The panelists are far better qualified to talk about those. What are the kinds of transactions? We used to see 100 million transactions so regularly in 21 and even 22. Clearly now, you know, a few, Pocket FM is a good example, capillary raising, just about 100 million. These are coming back, and we saw that big announcement of a secondary transaction at Lenskart yesterday. So those are beginning to happen, and some of them are actually down rounds as well. Again, something that the panel will talk about, what is the impact of such rounds. But clearly, there are primary infusions as well, and we are seeing some of those mega deals creep into the venture segment as well. There are a few cross-border ones, core being an example, but more relevant domestic companies are raising big ticket investments. Sector-wise, again, this is a volume split. Typically, when things kind of look shaky, we've seen B2B kind of overtake B2C. Come Q1 24, we've seen obviously enterprise continues to, but relatively speaking, e-commerce and fintech, which were down substantially in the last 18 months, are tending to tick up, and the old staples, healthcare and consumer brands, etc. Like you can see in this graph, continue to kind of small uptick, but year-on-year compares decently. However, so again, a point to the panel was, how deep is this winter? We've seen obviously these cycles come and go. However, some of them even kind of don't even reach the seed and angel stage. So this time around, clearly in end of 22, we saw that complete fall off in seed stage deals, and substantially Series A as well, and then it's come all the way to the angel graph line as well. So we've not even dared to project this for the year. We've left it as such, and the panelists can educate us. Having come the winter to the early stage, are they seeing signs of revival there as well? Very quickly, this is the kind of picture from a round perspective. Series A finally has turned around quite clearly, and this is something that we are seeing in this quarter, the current one as well, and obviously the later stage, growth stage rounds are not recovered yet, at least not in the data. Some of the cities that went up the fastest in 21, Bangalore, NCR, well known, are actually still hurting, and some of the other cities, including Mumbai, are doing better than they were in the earlier. Again, the panel can talk about Tier 2 and so on. Likewise in Hyderabad, likewise in Pune, and other cities. So in terms of the funds, we are seeing a little bit of the change of the hierarchy in terms of the most active funds. The key message obviously is that quite a few domestic led funds are that much more active this year than we've seen previously. This is the same picture from last year. There are more international funds last year who are that much more active than this year. Unicorns, again, there is a point to be discussed in the panel. So we all know there's a huge drop off, and what's happening to them. Again, the panel will talk about just two of them, but at least there are two of them from a quarter-on perspective, complete drying up in 22, and then a little bit of recovery in 24, at least two have been created. This is a report that, some of these funds on the panel and, others active in the ecosystem are contributing to. We actually put this report out for download by anybody on our website. The Series A landscape report. We try and capture, based on a cohort, how many companies graduate successfully to raising from seed to Series A and Series A to Series B and beyond. So we are working on the latest edition of this report. So just to read out some numbers here, it's almost 20%, 25% depending on which investor structure. Overall, the 30% mortality between seed and Series A, and then it improves from Series A backed companies to Series B and beyond. And some of these funds, are really catalysts to helping companies which they seed fund onto Series A and beyond. Again, we capture this metric as well in this report. Very soon we will update you about the next edition and how the winter has changed these numbers, if at all. We don't expect much. This is something anecdotally funds tell us. Quickly on to exits, again have been up and down. We know these, the story again in terms of the mix of, kind of exits that we have. The public markets, have started contributing to the venture segment as well. It used to be very dominated by secondary sales and obviously strategic sales. But, the mix is changing. The panel will talk about that as well. Some of the examples of the top venture exits, Mamaearth is a great example last year of an actual company all the way going to IPO. But obviously there are others as well, the roots as well. The panel is best placed to talk. So I will stop here and have introduction of Shashank formally, and then we can go to the panel. Thank you so much.
Thank you, Arun. I take pleasure in introducing the moderator of this session, Shashank Pandey, Managing Director, O3 Capital. Shashank Pandey, Managing Director of O3 Capital, leads the firm's consumer and financial services practice. With over 16 years of work experience in investment banking, he has advised Indian and global companies on M&A deals and capital raises, including cross-border transactions. Before joining O3 Capital, Shashank worked with Citigroup in India and Singapore. Over to the panel.
Thank you so much. Thank you. Thanks for the panelists for being here and taking the time. It's a pleasure to host this discussion. Let's start with the first and foremost question that's in everybody's mind. Is the winter over? I'm going to start with you, Subir.
Subir, please start with the introduction of the firm and yes. Thanks.
Hi everybody, this is Subir Monga. I represent Sovereign Investments. This is a firm that's been set up about 18 to 24 months ago by Sanjay Nair and Angad Banga. We just announced our final close last week at about $160 million, largely focused on the Series A and Series B space. To answer your question, I don't know. I don't think I'm an expert to answer whether the winter is over or not. What I can certainly say is that deserving businesses will attract capital. I think you are in many ways the gatekeeper of that, so you have a better funnel of which are the deserving businesses. So why don't I shoot that right back at you in terms of what is your funnel telling you?
Thanks, Ashok. Firstly, to introduce myself, I'm Piyush Goenka. I represent Prath Ventures. We set up Prath Ventures about 18 months back as an early stage consumer focused fund. Idea is to partner consumer brands in their journey very early and typically do $1 million check sizes from seed to Series A stage. So that's about the fund itself. Now to your question. I think I don't have very different views than what we said. It's very difficult to know where we are in this. Maybe I'll try to take as specifically to consumer, early stage consumer, what we have seen over this period. When we started investing about 18 months back, I think we were at a stage where we had come off a phenomenal rally. The excitement of 21 and early part of 22 had really disappeared completely, and even good businesses were finding it difficult to raise money. And I think that continued for a better part of the last year and a half. And that has definitely changed, as you rightly said. There is excitement which is coming back in pockets. Still, I don't see kind of people falling over themselves to do deals. But at the very early stage, there was also a lot of angel checks which were being written, and people, angels cutting $1 million checks and competing with funds and kind of taking that space. We saw that kind of really go down, and it was, I think, good for the ecosystem. A lot of that check, when it was being written, it was just the frenzy of the markets and trying to participate without really understanding what they were backing. And this I felt that this was something which was really important to happen, especially for consumer. And a lot of the investments which went in those companies, they're finding it difficult to raise subsequent rounds because those valuations were obscenely expensive. Businesses were not keeping up to those valuations, not able to grow into those valuations even 18 months later. So a lot of that was kind of good for the ecosystem. The interest is coming back. I think it will continue to grow. Maybe 6 months later, we might be able to say with some more certainty as to where we are.
That's fair. Vikram, from your vantage point, and building on what was just said, are you seeing any difference in terms of, or any changes and those changes in terms of growth stage, Series B, Series C? Is there any difference in terms of how fund is emerging or changing for those guys? Is there a differentiation, or is it a gradual sort of end to the funding window that you are seeing?
So just to quickly introduce myself, Vikram Gupta, the founder of IVCAP Ventures. We manage about 5,000 crores, all domestic capital. We just closed our Fund 3, which is 2,100 crores just in April. And our primary focus is Series A investments. We're doing an average check of about 50 crores in Series A. But we also do a small portion of our fund into seed stage now. I think to answer your question, and I was looking at the data which Arun was presenting, is if you just looked at that data, obviously one would see the drop in the investments, and especially on the seed and angel stage side as well. But the way we look at it, we've been investing now even more proactively. Even it's winter, you do a bonfire party, basically. That's a perfect time for you to make investments. In fact, last 18 months, we've deployed close to 800 crores, primarily Series A capital. And we continue to do the deployment. I think this entire 2,100 crores we plan to deploy in the next 24 months. We are seeing very good opportunities in the market, and we believe that this mindset that there is a scarcity of capital also helps you find the right entrepreneurs, invest in the right teams, right business models which are able to sustain this kind of a pressure of the market the way it is. And of course, given what has happened yesterday in the elections, I think people were obviously not expecting the kind of outcome. I think there is going to be some interesting trends one would see as an outcome of that. So I think we are waiting and watching that as well. I don't think the capital is going to come back as fast as what was anticipated earlier. Obviously, there's a lot of dollar capital sitting outside looking at the results of elections, wanting to deploy a lot more capital. I think that's probably not going to come as fast. So for us being a domestic investor, domestic capital, I think we see again that as an opportunity. For us, we'll probably continue to look for good opportunities and keep deploying.
Thanks for that. Your turn now for the tough question. Right? So I think you again bring to the table a very different perspective from your vantage point for how are you seeing some of things changing for the last 6 or 8 months and views going forward.
Sure. So hi everybody. I'm Kanika Agarwal. I'm partner at India Quotient. We are now deploying out of Fund 4 and generally strategy has stayed more or less the same. We do seed and pre-series A checks. So, we'll invest in a paper plan all the way up to some version of pre-series A. So for us, I was a founder right before this and I've spent some time in VC. So I've spent some time both sides of the table through 2021 to 24. And I think what's happened is that the bar is constantly a little bit cyclical, right? Like everybody said, good companies raise money, but that's always true. What's different is bad companies find it harder to raise money now, which is probably good, but that will also change. In 3 years, you'll have overvalued, shitty companies raise money. It will happen. For us, exactly like what Vikram has said, we've had a great last 18 months or so, we've been able to deploy capital. Founder expectations on valuations have come down quite a bit to where it should be. And so I think in the December quarter, we did 10 deals, a deal a week, really. So very, very actively deploying. And you usually find great founders in bear markets because those are the guys who are sticking around. It's not a, here I'm a, sorry, there are lots of consultants in the crowd, but I'm a consultant, it's a bull market. On my credentials, I'll be able to raise $2 million and get started. You see very few of those now. You see actual builders. And that makes a lot of difference in terms of the guys who are raising money. So been pretty good in terms of finding and deploying. And hopefully this is actually a better vintage. We sat out a lot of 21, so we didn't really deploy money that year. I think we totally deployed $3 million or so. So it actually pushes out how long you have to deploy. So we now have another year to deploy our funds. So yeah, it's pretty interesting and completely echo what everyone else has said.
Thanks for that. I think, Vishal, you sort of said that taking this overall scheme is a very vantage point. So how sort of are you seeing things because you get involved both from a rate side, so companies have trouble and very, very different perspectives. So how's been your experience over this period?
Great, thanks. Thanks, Shashank. Sorry. Thanks, Shashank. I'm Vishal Gandhi, founder of my law firm, Gandhi Associates. We focus on cross-border transactions. This is the 21st year of our firm. And since the beginning, we've been focusing on cross-border deals. So my perspective is actually very different. One, I have seen, apart from the funding winter and the cycles, that how sophisticated the investors and the investees and the founders have become. How acutely aware they are of what it really means to invest or receive capital and what that really means in terms of their own risks. Also, they've learned a lot from what's happened in the market, right? Where have things gone wrong with founders? There are many cases of that. Earlier, it was okay, we can invest and see it's a big market, promising founder, but eventually have they made profits or not? And are they still really running this venture as their proprietary concern, or are they implementing corporate governance? So a lot of these factors now, I think, have become matured. And because of that, people are way more conscious of deploying even $1 into a company. So many factors, apart from whatever else everybody knows and you read the papers, wars, uncertainty, what happened yesterday. So I think it's going to stay for a longer period of time, but irrespective of that, because everybody becomes so aware, it's going to be very hard to close a deal. I mean, first thing is, what's your moat? You have a great idea. You think you have the right qualification to run this business with what if an Ambani or Adani come into that space? What's going to happen to you? Simple things like these, which were not really focused on, I think, 15 years ago, maybe even 10 years ago. Plus the regulatory uncertainty, which you probably can't play. Thanks.
Thanks for that. Taking a lead from that, I think of what you mentioned, you were saying, right? Different sort of time periods in different sort of market environments result in different periods of investment. You touched a little bit about sitting out of 2021. How do you guys think about that in the form, like how we sort of take it a little bit down and notch it up as market changes, how we sort of try and create that?
Yeah, I think that has a lot to do with how much discipline you try and maintain within the firm. So for example, for us, we have mental models on we're going to invest, $1 million, $1.5 million, try and look for 15-20% equity when we come in. If you're not able to access good quality deals at that price, you shouldn't do them, right? You're not here in the logo collection business. You're not trying to really just say, hey, here's the 5 unicorns I invested in. You're actually trying to make money. You're trying to make good returns on the deals that you're doing, and that only comes in when you come in at reasonable prices. So as soon as prices are out of whack, it's just not something we can do. The flip is you should probably be selling a lot more at that point. And of course, while we did, there's a lot more we could have sold. So those are all, of course, lessons for all of us also, which is if you recognize the top, then also know where to sell at the top. But I think that, I said the bar is cyclical, but within the firm, it has to be absolute. And I think that is something that we have done quite well to try and make sure exactly like, where is your moat? Are your founders, the right guys to be building this business? What is their right to win? Are there unit economics that work at scale? Is this, even if it becomes, say it gets 50 million users, is it still a good business or a bad business? Right? Just basic stuff like that, where there are enough mental models that you should not just get swept away in the irrational exuberance, and still try and, first principles look at businesses, whether they make sense or not to invest in. So we continue to do that through the cycles, which is what I think has held us in good stead.
Thanks for that. So you have a reaction on this based on your experience?
In terms of ramping up and ramping down investments, to be very honest with you, I think if you look at a long enough time horizon, and that time horizon should be not just 3 years or 5 years, but look at multiple vintages across fund lives over a 20, 30, 50 year period. I think the data will show that time diversity in itself matters. So I think time diversity as a principle requires that when things are good and booming, you maintain your pace. When things are down, you maintain your pace. I think that is a discipline that, if it's maintained well, will hold you in good stead. I think maintaining the discipline on that part is what one needs to be consciously aware of. So I don't think it's a conscious decision necessarily to ramp up or ramp down. It's a conscious decision to be disciplined about how you not only look at pace of investments, but also when you're investing, what are you looking at when you're investing?
You decided a different perspective. You decided whether you sort of see that right now and then sort of start ahead. So your views on this?
So Shashank, I've been, while we started off 18 months back, I've been investing now for almost 20 years. Earlier as a private equity investor, now as venture capital. This up and down cycles have happened in the past, will continue to happen. Like Subir mentioned, it's about being disciplined. Because whether the markets are good or bad, good businesses don't come cheap. You have to be able to, at any point of time when you are evaluating deal, you need to know what you are looking at, what you are investing in, and what you are willing to pay for it. If one gets swayed easily by what someone else is willing to pay for, that can happen in any market, because good founders and good businesses always trade at a premium. How much are you willing to pay for that is something that you take a call as a firm and as an investor. So that discipline across all cycles is very important. It's not just for the up cycle that one needs to remember that one avoids it. And we have seen all kinds of businesses and sectors come into investor interest, and then there are hundreds of those businesses which just change their name, have very, very relationship to do that. And it's not just private markets, public markets, all markets behave like that. But to us, I think it never has been, at least in the last 18 months, having entered the market at a trough and coming from a private equity angle, we have only heard people have done investments without asking for EBITDA, or EBITDA doesn't exist in most cases, CM1, CM2, or whatever is the, people have looked at sales numbers, people have just looked at founders and kind of backed that. So while obviously at early stage you are backing founders, but if there is enough to be seen, one has to see what there is. We feel something that even now is not being practiced by a lot of investors at early stages, looking beyond just the P&L. Balance sheet is, and what investors ask for, unfortunately, becomes the way founders think about their businesses. So when we ask them their balance sheet, they will present something which is 18 months old and say that was the last time possibly we prepared this. So inventory, receivables, those are concepts, and kind of focusing on them. And it's through all cycles one has to remember that. One tend to forget it when there is Mahim around you, but if you don't look at it, even when markets are down and you are getting a good deal, you are bound to make mistakes.
That's a great perspective. I think because you sort of have access to very different kinds of investor networking, you formed this into a different value perspective as well. You I think just mentioned that you're looking at some of the CVC rounds as well, and you deploy a large amount of capital. Are you seeing, so two things? One is your reaction to what everybody else said in terms of payments, And the second thing which I wanted to start with you is that there has been now many down rounds of different shape and sizes. Right? People who have held back, they're coming up to sort of literally coming up for us like to meet that capital, and they wait as long as they can. I don't know what's your view and perspective on sort of investors, or companies approaching that kind of down round situation which is coming up and unlikely to materially change in the medium term.
Yeah, I think, typically VC funds, have a cycle, right? So let's say if you have a 10-year cycle, so over a 10-year period, you have at least one good cycle and one bad cycle. Usually, typically that's how it will happen. I think it's very hard to time the markets, but ideally you would like to invest in the bad cycle and exit in a good cycle, right? So I think, fortunately for us, we got lucky, I would say that, when 2021 happened, we actually didn't make any investments at that time. We actually made 4 very good exits. I think we were some of our best exits in 2021. And the people who actually raised a fund around that time and deployed their capital, there are quite a few examples, who actually deployed quite substantial capital in 2021. And they're still trying to get their mark-to-market back to that same valuation which was offered at 2021. In fact, we actually got lucky again when we did our Fund 3, and we were investing in companies who had grown 4 to 5x in the revenues from 2021 numbers, and we were still investing in them at 2021 valuations. So I think, of course, there is a general mindset that, when there is a euphoria, everybody's investing, everybody thinks that, oh, this is a good thing. One has to, very dispassionately look at, the time cycle, how long you're going to be invested. And I think more important than the capital itself, I think you have to think of what value you bring to the table. If your founder is coming to you for your capital and playing a valuation game with you, saying that, okay, I'm getting X valuation from the other guy, you have to match that. I think then they're not really valuing your time and the value that you bring to the table. I think if they don't appreciate, what you can bring to the table, I don't think that's a founder I would like to invest in. So I actually spend a lot of time with these founders before make the investment in terms of why do you want us? Why do you want our money? Where do you see we bringing value? So unless there's a connect on that, I think there's no point investing in them. So we do, like the way we do due diligence on these founders, we ask them to do a lot of due diligence on us. So I think that approach has actually helped us as well, because I think in the process, we've worked with founders for a period of time. Most of the founders that we invested in, we would have spent at least a year with them before we invested in them. In certain cases, 5 years. We actually engaged with them over a 5-year period. And, and when we decided to invest in them, they took our money even at a discount to the round they were actually doing at that time. So convincing the other investors that they want our money. So I think if the founders can see that value, that is where, the real success of a VC lies. So we strongly believe in value add, which is visible, which is actually seen on the table. And I think we don't like the term unicorns for a specific reason. Unicorn is a valuation of a $1 billion valuation at one point of time. The valuations move up and down. We know that, we talk about 115 unicorns, and I basically say these are the companies which had a $1 billion valuation at some point of time. Are they still unicorns or not? Nobody knows. Or at least many of them have dropped in valuations. We like the term, which I only learned from somebody else, the dragon term, which is actually on returns. So any investment that gives us more than 1x return of the entire fund size is how we define dragons, and we've actually started to create dragons. So I think that's what it's the actual returns, because we have taken third-party capital, we have to return that money. So we spend a lot of time on the actual value creation of the investment that we're making rather than the valuations.
Just a quick follow-up on that. I think you brought to the point that the investor has to, the company has to see the value that you bring to the table and vice versa, right? Just a quick follow-up that in your conversations, have you seen that happen, say, during 2021 time, or people were just, because the money was so free that they'll sort of come to you and say, someone's offering me a higher value, so either you invest or not, and has that changed?
it's a very natural tendency, you know, if somebody is paying you X valuation, which is much higher than somebody else offering you. You know, many times these founders get swayed that, you know, I'm getting such a higher valuation. But we've also seen founders who would actually know that this valuation is not sustainable. And therefore, even if they got a higher valuation at that time, later on, if they realize that they have to do a correction, for the long-term value of the business, they would be okay to do that correction. So we've seen that. We made a few investments in a fund 3, where we actually invested at a lesser valuation than what they raised in the previous round. So I think those founders are also very practical, very, I would say, mature founders, you know, who are also long-term founders. So you know, so that's important.
You've been in sort of my place, you've been as a sort of founder in a different place, and now sort of the investor. How do you think sort of the mental sort of framework is from the investor side when, let's say, a downround is happening, right? Because you've been on both sides of the table. How do you think they realize?
So, yeah, I totally get what Vikram is saying in terms of founders being mature enough to accept them. What we have tried to advise our companies, so a lot of them, for example, raised a lot of money in 2021, right? And a lot of them have enough of that left. And what they actually have to do is grow into the valuations that they raised at. So lots of these guys, there's a pretty big mentality shift actually, and that's across the ecosystem, where people are talking about unit economics, including founders and profitability, and we won't raise another round after this, and we'll use this to go IPO now. So hearing a lot more of that chatter, one within our own portfolio and generally externally as well. And I think that there's no sort of shame in coming to market for bridge or coming to market to say, hey, listen, I think we almost have it, but we kind of don't, so can we just raise a little bit more? And the founders who are fighting will do it, right, to make their company sort of work, etc. But that's absolutely right. I think generally 2 things are happening. Either founders are using the money that they raised at the top of the market to grow into their valuations, or on the other side, down rounds, etc. Sure, lesser of those. We're not seeing as many there. At least they want it to be flat. There is a little bit of vanity. I don't blame them. The third part of it really is us telling our founders to raise less. That's generally what we try to do, which is, why do you want this money? Overcapitalizing is probably worse than undercapitalizing a business. So as soon as we see that something's working and there is very clear use of funds, that is the only time you should go to raise. So for example, we have a consumer internet company doing a $15 million ARR, and it's profitable. It's currently marked at 25 million in our books, and it's doing 15 million ARR, right? That doesn't tie in, but there's no point them raising money for a markup. If they don't need it, if they have no explanation for use of funds, it doesn't matter how that's marked up, you know, that's going to go in 3 or 4 years. So I think it's very horses for courses, and you have to be sensible. You have to be sensible, and your founders have to be sensible, where they're chasing very different metrics and not vanity valuations.
Fair enough. That is sticking on that point on accessing sort of capital pools, right? And usually, I start with you. One, sort of obviously your fund has a certain amount of sector pools. But I look at capital markets and where they've been, keep the last 3 days out. They've sort of been fundamentally very, very good, right? And when I started my career, it used to be only the main board. Today, the C board exists, which does phenomenally well over the last 6, 7, 8 years, right? Every time it's recapitalizations, right? We want to try and bring companies to the table, and they need fund. A question which is more and more prominent today is, why can't I just go do an IPO, right? Public sort of event, good for the image, feels good, stock can go up anywhere, 100, 200, 300. How are you seeing sort of some of the reactions? Is that something that's coming up in conversations with founder, and probably I hope that the sort of panelists for that as well?
So Shashank, I believe people are building businesses with the right perspective today. When they find it difficult to raise capital, they go back to the drawing board and ask themselves, how is it that they need to relook at their own businesses so they're able to attract capital. So the fact that public markets are more open to new age businesses and or businesses which are showing traction. That's something which makes it definitely, that's a additional pool that they can dip into. But overall access to capital has become far easier. Forget about the highs and the lows. The access to capital is definitely far easier. You're talking about earlier, from what it used to be 15 years back to today, it can't be compared in terms of businesses' ability to attract capital. In between, when there are when there is a frenzy, then people just take their eye off the ball on the business side, and the focus kind of tends to shift to capital raise and valuations, which is what kind of derails the entire story. Today, we come in very early, so I think the relevance of IPO might not be there, but in discussions, when we discuss about possible exits, I think definitely more people talk about possible listings, the success of the few IPOs. But at the same time, they saw it's not just listing. Post-listing also, the pain that Zomato and Nykaa went through, it kind of shows them that IPO also doesn't mean that you've reached somewhere, and that's the end of the story. So you continue to build a good business, capital will be available, and more avenues exist today than what they used to earlier.
So we can continue with this, right? So this is building on what Piyush is saying. If people are building companies more from an IPO perspective, do you think investors are approaching the businesses and the business model slightly differently, and how they sort of lead that in that journey? Because they have this IPO end game in a way at mind, right? So things have to be done in a different manner.
I don't think IPO, I mean, some may be doing that, right? I can't speak for everybody, but I think from my lens, I don't think IPO is the be all and end all. I think when people start businesses, they more often than not should ideally have spotted a problem, and they believe that there is a solution to that problem. Could be in terms of a gap from a consumer standpoint, could be an enterprise standpoint. So somebody's trying to solve a problem, right? As they solve those problems, you get exposed to other problems, and then you create more products, right? Now the question really is, from a personality standpoint, are you somebody who's solving for a journey, or are you somebody who's solving for a destination? I think if you look at, the godfathers of journey, which is people like Mr. Narayan Murthy and the like, right, who started, or Mr. Deepak Parekh, they started this journey way back in the 90s and the 80s, and that journey hasn't stopped, it continues, right? So I think it really comes down to, do you want to continuously keep solving problems? Is that your DNA? Or do you view it as a endpoint? And mind you, there's nothing wrong with either, right? It's what you want to do. And therefore, for us, at least for me, I view this purely as a privilege. Can we be part of your journey, be it a continuous journey or be it a destination, right? It's who you are and how you want to play it.
I think that's helpful context. Is adding 2 points from our side. We do both anyway, at least me and my peers we have. I think a little bit we have played a role in that, call it a problem or not, right? We love to sort of advise companies to IPOs if the market's really doing well. Otherwise than this, I think what I have seen is as long as the founders are very, very clear on what they're trying to solve
Right, thanks. So even I just wanted to touch upon the IPO point a bit, and I'll come to this. So IPO is a huge responsibility. SEBI regulations on corporate governance themselves make life quite challenging. I mean, there's a recent regulation where within 24 hours of a market rumor, which is reported in the mainstream media, you have to either accept it, deny it, or clarify it. So you probably need a whole team, if you're a listed company, to just clarify, deny, or accept market rumors. So it's a huge challenge, number one. Number two, there is, I don't know how many of, probably on this panel, of course, we'll know, but in the audience, there is something known as a SPAC, a special purpose acquisition company, which is a blank check company, which investors will give to a team which is experienced in a particular sector. So let's say you're experienced in the internet consumer sector, so you'll raise $100, $200 million from various investors in a blank check company called a SPAC, and you have to deploy that within 18 months, otherwise you have to return the money to the investors. So some of the companies that we have advised have actually entered into a de-SPAC. So what happens is that an Indian company or a startup here will merge with a SPAC and you get a direct listing on NASDAQ, for example. It's challenging, there are a lot of structural issues, tax issues, but that is another alternative option for companies apart from a direct IPO. Yeah, that was on the IPO bit. On the regulatory part, I think, founders, investors have to be very, very careful today more than ever before. I'll give you an example. Just yesterday, 20 crore penalty was imposed on a company and 5 crores on the directors of the company for a simple thing like not filing a form with the RBI. The law is clear, but they just failed to file it on time. 20 crore penalty. And on the directors. So investors, if they have a board seat, you could be on the hook next. Of course, that penalty got reduced on appeal, significantly lower, but it's still in crores. So that is one part, that regulations now you cannot take it lightly. You should, as a founder and as an investor, encourage your potential companies to use regulatory sandboxes. So these are testing environments which the regulator is offering to you. If you're coming up with an innovative fintech product or insurance product, they let you experiment. And that experiment will sort of shield you from any regulatory violation because you're doing it with the permission of the regulator. Then you test your new product or new service. The regulator is watching you, allowing you to do that. And then eventually you may get a final approval based on what the regulator wants to do. So that is one way of mitigating regulatory uncertainty. But the message is, do not ignore or assume that it's fine, or do not try and find a loophole to say that because the law is not clear, let me do it. We'll see. Those days are over. Because everybody is very, very vigilant. And once you're caught in this litigation, whether it's regulatory or otherwise, because let's say you've represented to your investor that you're conducting your business in compliance with the law. Now what happens if there is a law change or there is some clarification by a regulator that this didn't mean this, but this meant that? You will not only be sued for misrepresentation, but the company will suffer. And by the time you challenge that with the regulators, you're probably losing 10, 15 years and crores in legal fees. So do not experiment or assume that this is the law, this is the regulation, I'll take advantage of a loophole. I'm not saying be very conservative, but reach out to the regulator, try and seek a clarification, or get some very sophisticated advice and then conduct your business.
That's very helpful. Just changing sort of a little bit on the track. A lot's happening on the ground in India. There's a lot where election results were expected or not. I think on the ground from what we see and what we hear from sort of lists like you and others, a lot's being built, a lot's being created and will continue to. What are sort of the top two sectors so that each one of you is focusing on or is on the top of your radar for the next 12 months?
So for us, generally, there are about four sectors in which you will find most of our deals, and this is, 100 feet view, etc. Consumer, we do a bunch of brands. So we've first investors in Sugar Cosmetics, Jiva, Silver Jewelry, etc. Content and social, right? ShareChat was incubated in our office. We've got companies like Friend, Local, Cuckoo FM, etc. The third one really is we do a bunch of software, and particularly within that, we believe a lot in trying to build software for Indian SMEs. I think the general thesis for us about 6-7 years ago was Indian businesses also want to buy software. They just can't pay $15 a month for US software, but they will pay $5, right? And you need to build and contextualize for India. And on that sort of thread, we've invested in companies like Vyapar, which is now the largest accounting software in the country by volume. We've got Pagar Book, PowerPlay, so across sectors, payroll, accounting, fleet management, construction, etc. So buildings, and the extension to that is just like how India will pay for software, all of Global South will be in the same way. So if you're going to build this for the globe, build it for contextualized globe, which is the developing world. So interesting how these companies will play out. And now, of course, you start dabbling a bit in global SaaS. We're quite strong in agri as well, a little bit of AI, etc. So I know this sounds like everything, but I'll narrow it down a little bit. For me personally, I look at consumer and fintech. Within consumer, I've been spending a lot of time, for example, in One Kids to see what is going on there. You just, as soon as you become a parent, you find all the gaps in the market. And also, have a very strong thesis on how microtransactions will play out online. It's the exact same thesis in terms of how Indian businesses can pay $5 a month. Most Indian consumers who are coming online, their entry point is 25-30 rupees on a transaction to get started. So using that as a wedge, what can you build around content, around social networks? So for example, a company that we have called Cuckoo FM, the whole thesis is housewives, blue-collar workers that work with their hands but still want to listen to content will, listen to it, right? So how do you build audible in regional languages? And you pay microtransactions. You pay per episode, you pay per serial, etc. And then those become very, very large outcomes. So that, and of course, fintech, but that is a whole other ballgame. I think, there are lots of other sort of double clicks on regulations there. But those are spaces that we're finding pretty interesting right now. So, sorry, anyone building in that space, please find me after this.
So we are a sector agnostic fund, and we are a very entrepreneur focused. In fact, our anchor investor is the IIT Alumni Trust. So we get a lot of deal flow from the IIT alumni ecosystem. But that said, of course, there are sectors that we are going after. So of course, like Kanika mentioned, I think we are also looking at consumer in a big way. But at the same time, I think we're looking for disruptions. So we're looking for what is the next wave, what is disrupting. So I think we obviously look at all these deep tech, new wave technologies, which are actually disrupting what's happening right now. So all this generative AI is actually becoming very, very interesting. So there's a lot of disruption that we are seeing happening across different sectors. Healthcare is another sector which we are actually quite excited about. In fact, we believe there's a lot that has happened in developed worlds which has not yet happened in India. So healthcare is one area we are actually spending a lot of time in. And of course, broadly, the reason we believe in this model of execution, effectively it all boils down to, the space and the entrepreneur. And effectively, we would have invested in a Purple against a Nykaa. We would have invested in a Biryani by Kilo against a Behrooz, or a Clovia against a Zivame. So these are the teams that we thought, even if they're not going to be number one, these are teams which we knew were going to be very capital efficient. So we're actually investing in the capital efficiency mindset to actually create large outcomes with limited capital in spaces which we knew were going to be huge.
So it's easy for us. Yeah. So yeah, we look at everything in consumer. Obviously, within consumer also there are so many subcategories which are exciting. So maybe I'll take this opportunity to tell a bit about what our core thesis is. We believe that India presents an opportunity over the next couple of decades to build consumer brands across categories. It's It's an opportunity which hasn't existed earlier in the same manner, and we are very excited about it. There are a multitude of reasons. I think most of the people here know that. I will not bore them with the reasons for that. But that excitement kind of extends across multiple categories. Some of the categories have seen early winners emerge, but I think these categories are so large, and some people ask us, do you see clutter in some of these categories, let's say like beauty, personal care? People say there are so many brands. I personally feel that there is several more that can come. As and when a brand comes, the question that they have to be able to answer is, why is the consumer buying them or preferring them to choose over others? That's something that if they understand and they're able to really scale, I think opportunity exists everywhere. So beauty, personal care, I'm talking about, we lost a couple of deals very recently. So we're looking to do something in that. Everything else, kids is a very exciting space. We would want to do something in fashion. We are outside of consumer categories, we also look at consumer enablers. We believe that ecosystem is developed, but will continue to be developed. We'll need to do a lot more. If e-commerce has to go 10x from here in the next decade, that is going to need as much investment in both the digital and physical infrastructure to be done. So that's a space also very exciting to us. Yeah.
I think if we were all very honest to each, ourselves, we'd all agree that the sectors don't really change, right? It's around consumer, it's around financial services, around B2B enterprise. I think it remains about the same. I think what really changes is why now, right? I think goes back to my point on time diversity. I think ecosystems change, new base platform technologies evolve. Gen AI being an example today, internet being back in the 90s. So it's more a question of business models and why now, right? To Kanika's point, if Vyapar was there maybe 15 years back, SMBs would not be able to afford it. Because of the mobile, the question of why now gets answered. So I think if you were to look at that slightly differently, the relevance of that business starting today, not at a scale, but starting today, and what are the tailwinds from a characteristic purposes allows it to scale and have a going concern, if you may, over a much longer period of time, right? If Uber were to be started before the iPhone came and Google Maps came, there would be no Uber, right? I think those are the things that we focus on a lot more. I think size of market, founder, mode, I think all of us are following for those things. Why now is a different flavor to it.
Just one point before I had something to try out this in a question for you, right? Just maybe so we can start with what you guys touched upon AI. If I look at all the communication news and excitement that's coming from the value side, it almost makes you feel I'm already in the matrix, right? Then I start moving towards it, and then things are a little bit more realistic, right? I think the exuberance around AI is a lot more in that particular part. You guys did touch upon it, but are you seeing it to be a meaningful enough space where people are trying to create something there? Or still, I would say, lack of GPU, lack of other stuff is holding people back because the amount of funding is not as crazy as it's in the value side? Just purely on the AI perspective, what are you guys seeing?
I think it is a rapidly developing space. So what I tell you today may not be relevant tomorrow. That said, I think just the cost of compute and availability of compute, I think sits in the West as it stands today. I think from an India standpoint, as it stands today, our right to win probably exists in maybe one or two spaces. One is, at the application layer effectively. So using the compute and using the LLM layer. And the second space where a bunch of people are trying to solve for it, we'll see how it eventually plays out because there's a lot of work required to do there, is actually more from a vernacular standpoint, right? Large parts of the West is English speaking. Even a large market like China is fairly homogeneous in Mandarin. I think India is many languages, many sub-languages. Within that context is different, right? So I think in that context, there is a very unique opportunity to build this. The challenge continues to remain how do you monetize it, right? And who's willing to pay for it. So I think there are a bunch of spaces rapidly developing.
So we see more in the consumer space are more users of this, and that's evolving at a very fast pace. A year and a half back, a year back, 6 months back would be very different, but today we hardly come across people who are not using in one or two of their consumer engagement or fulfillment some software which is AI enabled. We see some enablers also which are using AI to kind of be able to fulfill the requirement of the space more. But we are a little bit away from this as our focus is on consumer brands. We would see this as something that becomes almost necessary to use to be able to do your business.
So I think very clearly it's happening. We know that. I think it's a matter of what are the points of inflection over time. So I think there are multiple points of inflection here, right? So far what we are seeing is very obvious disruptions which are happening. We're seeing in content space, we're seeing in legal, we're also seeing in media and entertainment. But I think you'll see this happening more and more in research areas as well, where this will become very domain focused over time. So as more and more data gets generated, I think any AI system will be as smart as the data, the quality of the data which it is accessing. So I think unless this data access becomes more and more prevalent for these models, I think it'll be very difficult to really get the true value out of the AI models. So I think that is happening. People are building very specific models. So we're investing in a company which is actually doing AI for financial services, and they're working with very large investment banking firms, where the amount of data that they are accessing is of a very different type. So the data which is getting generated every day from the stock markets, from the regulatory side, from various other places, and then advising people in different ways on the compliances side on how to manage their processes. But I think it's all dependent on the data which is actually getting generated on a daily basis. So same thing will happen in the healthcare side as well. So I think you will see very, very domain-focused models which will emerge over time, and that will be a very different kind of disruption. So, but it's happening, and I think it will continue to happen.
Yeah, for us, I think the call we've taken is twofold. One is the models will likely be developed outside of our investment. They're very, very capital intensive, and it's a different game. At the application layer is where we will end up investing. And there, I think the mental model is with the next version of ChatGPT, does your product become stronger or weaker? Right? And I think Paul Graham or Sam Altman or someone said that. And I think that's a great way to think about it. Are you excited by 4.0 or are you disappointed? And actually we have that in our portfolio also, right? We did a bunch of investments early 22 before ChatGPT, and very, very strong teams, but a couple of them have no right to exist anymore because a lot of what they were trying to solve is very easily solved by GPT. So I think that you have to wear that lens when you're looking at it. And the other one is just like all of your iPhone and data, etc. This is another paradigm shift. It is software. It is far more powerful software. It will power almost everything that we see today, how this table is made and, how we're conducting this conference, etc. So there is a complete new form factor that is emerging, and using that, you have to start evaluating things from that lens. So I think those are the two ways we're trying to look at how AI plays into our portfolio or future companies.
I think, Vishal, this is great because one of the world, right, and we already seen in the West that this has come with a wave of sort of regulatory, I would say, changes, but questioning and a lot of cases and lawsuits. India as a landscape, you always have to be very careful on the regulatory side, pretty much any sector, especially if you're getting into something new. How do you see, one, just the broader regulatory landscape and any meaningful changes, and specifically on this front?
Thanks. Very interesting question. So yeah, firstly, from a business side, it's going to stay, it's here to stay. I don't think it's going away anywhere. It's very productive, very efficient to use. It's like a co-pilot, right? It just makes your life easier. On the regulatory side and the legal challenges, data protection, privacy, copyright issues are going to be a huge issue because ultimately it's training on other people's data. Who owns that data? Is there a copyright on that data? Has a license been taken for using that data? When you input something into, let's say, a chat GPT, are you disclosing confidential information of your client, for example? Is somebody going to sue you if there's a data breach? So these are the legal regulatory issues, but I think sooner or later there will be a specific AI regulation which the Indian government will come up with. Given the uncertainty now, I don't know when that will happen, but sooner or later whichever government will have to come up and address this issue, because you know, as somebody mentioned on the panel, what I speak today will become irrelevant tomorrow. That's the pace at which AI is developing.
Thanks for that, and thanks for answering all the sort of questions. Maybe with this we open it up to the floor and any questions from the audience.
Any questions? Okay, so let me kick off then. So Piyush, you know, this is probably a trend in the private equity to venture space. Fund managers like yourselves, you've been private equity, and Vikram did that, you know, quite a few years back. How does it, you know, kind of work typically from mindset as well, right? So switch from private equity to venture, and maybe you can relate why the switch, and then, you know, what does it take when you make that switch? Vikram, you could add.
Actually, it's something that has been asked several times, a lot by our potential investors in the fund. But I see the way we look at companies hasn't changed much. Eventually, and I was a growth stage investor, and you have known me for a long time. At that stage itself, you're backing a good founder in a good business. So sector and founder call are the basic things that you are taking, which doesn't change fundamentally. Obviously, you have much lesser things to look at to validate your thesis, and it's more, and you will also enter into many more emerging categories which have not yet proven. Forget the business, but categories itself are emerging, and hence you need to have done far more homework. So having been in the investment space, I think we are mostly, when we invest when we are even meeting a company for the first time, the homework on sector is already done. So other than that, I think one needs to, I don't see too much of a change. Just getting used to the volume is something that I'm still adjusting to, from kind of seeing, let's say, 20, 30 deals in a month to seeing hundreds of deals in a month, and kind of how do you do justice to that? And it's something that we regret in terms of the pace at which we are able to respond to that. But initially when we started out, we said that 3 days we have to be able to revert to anybody. But to genuinely do justice and do that within 3 days, we find it challenging. And I think it's because the rigor that we put every single investment through, having been a private equity investor, kind of not being able to just say just on the basis of cursory reading, okay, this is not, we would do that for maybe 10, 20% where it's not a fit at all, or we do not believe in that sector completely. But otherwise, I believe as an investor, you need to find good founders and good sectors. That's what our job is, and you have to do that irrespective of the kind of stage that you come in. Obviously, the good part of it is you can make a little more mistake than as a private equity investor you are allowed to. You will have the portfolio construct changes a little bit. Though our core belief is that consumer funds, and we have seen and we have studied portfolio of a lot of consumer focused funds, it's very similar to what private equity constructs are, and hence it's not the power law which is very, very relevant for overall VC as an ecosystem, might not be as relevant for consumer-focused early-stage funds. But still, the fact that you're coming in very early and you will have many companies which deliver more than 10x for you allows you to kind of make more mistakes, back more founders, and allow them to make mistakes. So I think that's...
So, that's a great question, by the way. Actually, when I started IVCAP, there were 6 or 7 other funds that started at the same time. And all of them had one common thing. Their founders all came from Mumbai Angels. So they came with that angel investing mindset. I was coming from the private equity side. So I think one major difference that I realized was that, we raised 240 crores for our first fund, and there was another fund which raised 125 crores. So that fund actually invested in 80 companies. With the 240 crores invested in 10 companies. Now, if you've invested in 80 companies with a 120 crore fund, so you're actually putting a crore or less than a crore on an average. So the portfolio management becomes very, very challenging. Effectively, you're investing in an index, basically, and then hoping that whatever is doing well, then you start backing them more. So that's a typical VC model. It's a typical global VC model. So in a PE model, you're actually handpicking the entrepreneurs you want to work with very closely over a period of time. Before you invest in them, you spend a lot of time with them and see whether you want to work with them. And then once you invested in them, you actually work with them and make sure you really take them to a point where they give you meaningful exit. So that's the fundamental difference in terms of how much time you want to spend with these companies after you invested with them. So I think typically, the PE mindset is more driven by exit upfront. So actually, when you're investing in an entrepreneur, you ask that question as the first question. How am I going to exit from this company? How am I going to, what kind of returns? What will be the type of exit? Am I going to do an M&A as an exit, or is it going to be an IPO in the time frame? So those questions are asked upfront even before you made the investment. And the VC mindset typically would be like, okay, this is a good entrepreneur, good space, they will do well, let's put the money and then see what happens. So that's a fundamental difference that at least I see. I've tried to marry the two, actually, in terms of, bringing the private equity mindset to the VC investing, where you basically still pick very concentrated portfolio, and then still take those early stage bets in these companies. And, so effectively, if you can do a combination of two, you still get VC returns in a PE mindset. So that's basically what's interesting kind of a thing.
Thanks for that. Any questions?
If I may just add a bit to, I got reminded by something Vikram said. I think having done later stage investing, it really puts the ability to be able to think about how you will be able to exit this and what the later stage investor is looking for in a company 3-4 years later, kind of really enables you to kind of prepare the company in that way. So public market investors actually do very well as private investors, late stage private investors, and I would say that seeing how Vikram has done, hopefully we would be on the similar path and we would be able to kind of gain some benefit from our private equity experience.
Thanks. Go ahead.
I just wanted to ask you, like many funds here have similar LPs, SIDB being one of them. How do you perceive a lot of LPs co-investing now and taking direct bets? Is that something that as a fund manager you take positively, or is it a negative aspect that, well, LPs are directly now taking stake in some businesses, and why is that becoming more and more apparent? I mean, even family offices do take co-investments and they're sitting as LPs as well. I see that sometimes in deals we're working on. So is that naturally a progression, or is it actually a regression?
Maybe I can start and then. So 65% of our capital is institutional capital. We have 25 Indian institutions. SIDB, of course, has invested across all our funds. But we have banks, insurance companies, except for State Bank of India, which has invested across our funds. No other institution has co-invested with us. SBI actually co-invested in Biryani by Kilo with us. We don't see that in Indian institutions, at least. We only 10% of our capital, which is family capital. Now, we are seeing a lot of interest from the family offices to do co-invest. In fact, that's one of the reasons why they invest in funds. They say, if you're actually giving us co-investment opportunity, only then we are interested to invest. Now, from a fund's perspective, it's interesting only if these investors, these LPs are actually bringing a lot of value along with their capital. Just like we expect the entrepreneurs to do their due diligence on us, whether we can add value to their businesses. Same way we do due diligence on those people as well, in terms of what value they can bring to our portfolio. And if we see that value, and this value could also be, for example, they want to be strategic investors, they want to take small stake in our portfolio companies, and over time, they could be buyers of our portfolio. You know, that company they may want to acquire completely. So, and they may bring a lot more capital, a lot more strategic value from their core businesses. So I think when we see that value, that's when it becomes very exciting for us.
So, just a couple.
No, I was just going to talk about, it's kind of similar to Vikram. So generally we just run almost a formal co-invest program, right? Where the waterfall really is we're going to invest, if there is something left over, we can offer it to our LPs, and we always do that. Usually the guys who invest are people who already actively direct invest, where they've done work on your companies. So for example, they like company A, so they've already engaged with them for 3 months prior, they understand it and they're ready to pull the trigger right at that point. If you're taking deals to them saying, "Acha, term sheet ka la rahi hai, aapko karna hai," those usually don't happen. So the guys who are doing it are ones who are trying to build direct investment portfolios. It does two things. Like Vikram said, they're saying, "Acha, we want to come in, only if we're coming in, we're able to do it." A lot of family offices do it. It's also a way for them to shrink fees, right? Because it gets spread over a little broader investment corpus, etc. So usually the guys coming in are ones who have already done their homework, but I think you will find most funds at least offer things to their LPs because it is something that is asked for but usually not exercised.
You've covered mostly everything I want to say. I think most of these guys are looking for these as rights. They don't want to miss out on possible opportunities. A lot of them do not end up really exercising these rights. That's been our experience. And typically at our stage, there is a possibility. We do not mostly do the 100% of the round. We have the ability to take it to our investors. We have seen most of them would want to see it, but not necessarily wanting to. So this is more of a right that they don't want to miss on. Some family offices and some people who are actually have aspirations of one day turning those family offices into third-party fund management firms, those are the ones which are kind of look at it actively, are anyways doing direct investments, and they kind of look at it seriously.
Any other questions? So,
Hi, thanks for the interaction. My question is more on the growth ceiling that you look at in terms of the consumer brands that you are invested in, especially in the e-commerce e-commerce growth. And second related question is, how do you see the online to offline transition for the portfolio companies, and what are some of the markers that you look at whether the brand would be able to scale efficiently in the offline space?
Could you repeat your first question?
Yeah, first question was more on the growth ceiling that you look at in terms of the consumer brands that you're invested in, especially in the e-commerce space. So a lot of consumer brands, either in BPC, have, struggled to grow beyond certain point, and they're facing challenges, and there is discussion around the possibility that is imminent that they would have to switch to offline. So two related questions on the growth ceiling, and secondly, what markers do you look at when you look at a consumer brand, whether they will be able to switch to a offline distribution?
I don't think there's any growth ceiling we look for. I think we obviously, when we look at companies, we actually think of, can these companies do $1 billion in revenue at any point of time in their life? So that means, is the space large enough? Even at a market share that they can acquire, can they become $1 billion in revenue? It could be 10 years, 15 years, 20 years, we don't care. But I think as long as the market is large enough that these guys can reach that revenue, which means over the life of our investment, there will still be a substantial story out there, for the next buyer of ours. So we look at it from that perspective. On your second point, offline, online, in fact, I'll just give you an example. So many of our companies actually, have seen that. We recently invested in a company called Snitch, which is a fast fashion for men's. Then we invested in Bluestone. So Bluestone actually started, jewelry company just started as an online only company. And interestingly, during COVID, they started setting their stores. They set up their first store in COVID, and today they are more than 200 stores. And we saw that when they started setting their offline stores, their online sales went up substantially. So, especially products where people have this trust factor, so if they see the offline presence, they start placing more orders online. So an omni-channel approach always works much better because they feed into each other. And, so same thing with Snitch. Snitch was a purely online business till our investment. So we just invested 6 months ago, and they've already set up 10 stores. And now again, their online sales have started increasing quite substantially.
And large format, right? Like Snitch.
And yeah, it's a combination. So they have high street, they have within mall stores, etc. So yeah, so of course, the format of the stores also matters a lot. What kind of formats you have. Clovia, for example, is another example where it was all purely online model, and then they started setting up their stores, and we saw a huge jump in their overall revenues after they started setting up their offline stores.
I'll just add one point there. So online growth ceiling, there is a little bit if you want to grow profitably, because Google, Facebook algorithms essentially mean there is a bit of diseconomies of scale. As soon as you start hitting, 10, 12 crores a month, it's actually unprofitable to grow online. So you had a bunch of brands that have scaled down online and then gone offline to grow, and offline taken very different journeys. Increasingly, we are coming to the conclusion that large format stores like what Manyavar has done is a fantastic way to grow offline. Unit economics at small stores and then trying to get them profitable is very, very hard. Can you actually do a 10,000 square foot store, try and get to 2 crores of sales from a store a month and have only 30 of those, right? Instead of doing 1,000 stores of small formats across the country. That's one model. And then the other model is actually using GT very well, which is what Sugar has done fantastically, which is forget the stores. Of course, you can have some, etc., but you're actually in general trade. So it is dependent on the product type. For example, Bluestone obviously is not GT, right? It needs stores, it needs what it needs to. Same with Jiva. But a Sugar or any of the other BPC products should actually be sold at the local chemist, at the local beauty store, etc. And you have to do this online and offline. Vikram's exactly right. There is a virtuous cycle. They all come back online and buy again. So that is the only model that seems to work. At least that's what we've seen also.
So I have a slightly different view. While I agree that over the last year and a half, when it started becoming very expensive for D2C as a channel to grow, unless you were willing to bleed a lot, I think the buzzword became going offline, and we saw a lot of guys kind of going offline. I think it is a matter of category, price points. Not all brands are at the price points at which they prevail. Most of the new age brands are ready for offline. There are offline markets are very different. One needs the understanding of how to build offline, which is the relevant. Offline is not one channel. Firstly, offline is so many channels, so many different ways of doing this. We have been investors in our past lives in mostly offline businesses. I have a deep understanding of that. But the first question of yours is actually more relevant in context of this, that I think there is no ceiling for growing online today. The challenges which a lot of brands face on that growth is more because they have not been able to answer on the value prop to the consumer. If you do not have a value prop to the consumer which is strong enough, you will struggle in every single channel. There is obviously, as brands grow, you need to be everywhere. You need to be offline as you grow and you cross a certain threshold. The way today consumer shops, that entire funnel has evolved so much. It is so offline, online into each other, where the consumer first sees it, when the first when first brand comes into the consideration set to when it finally consumes, it's very difficult to know, and hence validation or trust of that brand goes up several notches when consumer sees it across all the channels which it views. But we strongly feel that one can delay that. Okay, there is a time when comes in the journey of the brand when it will not be a choice, but it's not that you will have to do it when you've reached 50 crores or 100 crores. I think most categories today or in the next 5 years will allow brands to build several 100 crore brands online alone. Yeah, quick commerce is a great answer. Actually, quick commerce answers a lot of the problems which are there. What quick commerce is doing for some of the categories is phenomenal. Food and beverage today, for people to even think about going offline is, I would say that it's just such an inefficient use of capital. When you can utilize quick commerce as a channel which is so friendly to new age brands, it was for the long time. Today it's becoming difficult for new age brands to list over there. Just going offline is a very, very difficult, and the reason why, actually one of the reasons why it was the reasons for D2C brands to exist was earlier it was impossible to create a brand pan-India unless you're willing to invest 20 years in creating the offline channel. You were able to get to every single relevant consumer at the click of a button by listing it on a marketplace or having your own website. The nimbleness with which you can do the business online cannot be replicated offline. So people tend to forget that that's the part of the reason why that business was attractive itself. I think they're trying to solve the wrong problem by saying that let's go offline. That's if that's a question which comes into the mind of the founder when he's at 50 lakh monthly run rate, 1 crore run rate, then he needs to ask himself, is there something wrong with his brand, with his product proposition?
No, I think just to add to that, I think even like how online or internet in itself was an innovation in terms of channels to distribute D2C products, I think even offline is going through its own innovation. So quick commerce is a form of innovation on offline distribution in many ways. We've invested in a company called Light Store, which is a form of allowing for D2C brands to distribute offline in a very differentiated manner. So I think that the tailwinds are there. I don't think there's necessarily any ceiling to growth. I think it's not a function of channel, it's a function of a founder saying business banana hai, abhi online ho, offline ho, figure it out. Right?
Sir, I have a question. As far as valuation is being concerned, the burning which is being considered, or there are certain business models which are offering burning in initial periods. So burning versus impact analysis of that burning, is there any science behind accepting the financial projections or giving a valuation though the company is burning?
I think we're all figuring it out. This is VC 1.0. Honestly, everyone is in their first or 1.5 exit cycles where they are learning a lot of things. But we were talking about Zomato as a great example of a company that has burnt a lot of money when it was private, and then got to a stage where operating leverage, public market accountability, etc., actually helped a lot, and it is now profitable. Hopefully it's going to get even more profitable. So you're right, there is, same with Flipkart, right? There's a whole bunch of these examples, but can you say that they have not created value, they've not found product market fit, or they don't have reasons to exist because they're burning money? None of those are true. The flip is, of course, bad habits translate across the board, and people think that this is just true. Every company should burn money. There are businesses that need to be run like dhandas, like our dads would run them, right? Like a B2B marketplace should be profitable on day one. There is no reason why it's not. But that is not true for a consumer marketplace. A Flipkart needs to burn money. It needs to get customers on board. We just invested a company called Pop Club or a Zepto, or any of these guys. They will burn money early because there is network effects being built, or there is large consumers at which these things make sense. What is the mental math there? I think there will be science that will emerge, but intuitively you can tell when some numbers are too large, right? So if a company burns through $10 billion to go anywhere, that seems unreasonable in any realm. Where how large will that company possibly get? It's burned 500 mil, maybe there's a world in which it should have burned 500. So I'm sure that's a terrible answer, but that's the best I have at the moment.
Maybe I can just add to that. See, actually, I think valuation technically, what is the technical definition of valuation? It's the net present value of the future cash flows, right? So that's the technical definition. Now, if your cash flow burn is for the next 5 years is substantial, but for the rest of the life is going to be substantially cash flow positive. So obviously your current valuation will factor that and actually look at a very large valuation, right? So look at Amazon. Amazon burnt substantial amount of capital for the first 10 years, but when they made profit for the first year itself, it was very close to $1 billion of profit, right? So, and then today it's over $1 trillion of valuation. So I think, it's about, when you look at fundamentals of a business, I think we look at how capital intensive the business is, how much capital it is going to absorb to reach where it is trying to reach. We also look at the gross margins in terms of what is the profitability of the business. Will it be profitable enough at scale? And to reach that scale, how much capital do you need to put in? And if you as an investor don't have that kind of capital to put in, then the next question obviously is who's going to be the next person who's going to put in that capital? If that person doesn't come in and put in capital at that stage, effectively you've already taken that risk up front. Effectively, you typically look for a J curve, but it could also be a W curve, right? Where you actually, you put in money at the time when they're just about to reach profitability, but you're losing your capital. Again, they want to become EBITDA negative and reach another level of profitability. So it all depends on the kind of business you're investing in and what kind of gross margins and net profits that you can generate over a period of time.
So one more thing, how you guys look at the QSR segment at early stage? QSR, quick service restaurant.
I think even there, not today, but about 5, 7, 10 years back, there was an innovation called Cloud Kitchen that came about. I think scalability in some of these business models, from venture standpoint, you have to decipher whether they're linear versus non-linear. And if you're taking a linear growth bet, then you should be conscious about that. Cloud Kitchens allows you to take an effectively non-linear bet on food as a category. Dark outlets from quick commerce is an example of that effectively. I think there's a lot more to come as far as QSR is concerned. But my bet is that would largely happen through the Cloud Kitchen ecosystem. In the offline ecosystem, it takes a lot of capital. The challenge in India from an offline standpoint is that cost of rent way surpasses what people can afford for a product. So, like the other day I saw a hoarding of Burger King, 2 burgers for 99 rupees, right? What are you going to cover in your cost? Your rent won't get covered, right? So I think there's a lot to be done. There's a lot of categories to be built. It's a function of, again, founders finding categories and finding innovative processes to create a product that is healthy, tasty, and can be scaled within certain economics, which is affordable to India.
Thank you, sir.
I wanted to ask a question on fintech. A lot of VCs are interested in fintech, but a lot of subsectors within fintech are already crowded. So which subsectors do you think have still potential to grow? And also with RBI regulations coming in fintech lending, unsecured lending, what's your take on that?
I think you look at categories across, so I don't know why you believe that it's crowded, to be very honest with you. I don't believe it's crowded. I think we have massive gaps in SME lending. I don't think enterprise lending is somewhere where venture capitalists should be playing in any case. SME lending, massive gaps. Consumer lending, massive gaps. Innovative credit required at point of sale, massive gaps. Insurance penetration, one of the lowest in the world, massive gaps. There are always newer ways of payment technologies that come out. I mean, in a country like the US, while India is more advanced, in a country like US, Apple Pay exists over there. We don't have an equivalent necessarily of Apple Pay in India, but there are always technologies that keep innovating themselves. I think, my colleagues and I, we try and spend some time on looking at the wealth management space, right? Look at the amount of SIPs that are going into the ecosystem. can we look at alternative ways in which wealth management can be solved for, apart from what the Angel Ones of the world or the Kotak Wealths of the world are trying to solve for, because they're catering to a very different ecosystem. So I don't think that it is crowded. I think it really comes down to founders finding innovative ways to addressing these gaps. I don't necessarily think it's crowded.
And what's your take on fintech lending, unsecured lending? With RBI regulations coming in, that they are asking to shift to more secured lending rather than unsecured.
I think more than the specifics of the regulations, I think it's a good thing that regulations are coming, because for the investor and for the founder, you have a framework now within which you have to operate. Of course, if there is some unreasonableness or gray areas in the regulation, then that's also a good thing, because you can approach the regulator and get it clarified, or you can challenge it in the court. So any kind of regulations in a new sector, I think the first reaction for me personally is it's a good thing, rather than just, assuming that this is what the regulator will take a position on. So that's my take. It's good. It's good for the industry.
Hi. Pundrakaksh from AZB and Partners. I just have like a two-part question, one on fintech. I agree with you. Sure, it's not a crowded marketplace, but do you think thematically we're going to move towards from where we were in spending, with your lending being as a sort of a subset of just consumer spending, to more the wealth preservation and investment strategies outcomes? Like, is this going to be the half decade of sort of investment solutions as opposed to lending solutions, which the previous half decade has been about? My second question is on AI. And there it's a little more, I heard a software engineer say this to me, which was that, AI is every software which hasn't started working yet. That if there's a scope of unreliability, that's when you say that it's AI, otherwise it's a calculator. So given that situation that we are in, where it's not fully, completely reliable, the fact that, yes, there are some extreme specialized use cases, in the short term, given the fact that developing these models is a capital intensive process, it's highly unlikely a startup is going to be able to undertake that without access to that capital. Should they be working at, like, the LLM ops field, where we've already seen a few breakouts? Should they be working at the UI UX interface arena, where like trying to make it more palatable to an audience that has generally only worked with Excel as opposed to a chatbot? Or should they be looking at just the integration play? Like, for a long time, our ITES solutions from India were an integration play. That, we'll customize your software for you and you run it on your softwares on your own. So where do you see the highest potential for an aspiring startup in AI, at least in the short term?
So the first question was on fintech. Will there be more investing now, like more lending earlier? Look at your own bank account, right? You're probably doing both. You're probably going to borrow some money to do something, and then you're probably going to have SIPs. If that is the macro behavior, that is how founders will build. You cannot say one will exist over the other. There is enough tailwinds across the board. I think from our perspective, what we're trying to look for is, where are there very large profit pools, and where are they not so concentrated that you can't attack them at all, and then try and go after them a little bit, right? That is how we are trying to view this. Wealth management is much, much harder, because it's very distributed, very small slivers of profit pools you end up getting to attack, so it needs to be very, very innovative, and maybe AI plays an interesting role there. But they'll both coexist. And the second part of your question on where to play in AI, it's going to be, again, across the board. Maybe it's a great time to actually reimagine software for the country, right? We're importing $20 billion worth of software every year, all your Gmails and Googles of the world, and Microsofts, etc. Maybe someone's going to build OS here, maybe someone's going to build the new age Excel, the new age email, and all of that will be done using AI for Indian context that hasn't been done so far. So yeah, very interesting. We'll see, and we're happy to back companies like that, honestly.
Just a couple of points to add on that area over time. I think on AI, probably the LLM models that you talk about are sort of 2 layers down, and I think you said at the start,
Thank you, panelists and the audience, for an interactive session. Now I would request all the panelists to step forward for a group photo. Meanwhile, I request Mrs. Uma, Managing Partner of Zenith HR, to come on stage to give away the mementos. We would once again like to thank all our sponsors, speakers, and the audience. Thank you so much.